fiscal shocks on global economies. So we will have two panel sessions. The first one will be perspective on macroeconomic developments, and the second one will be on global markets and trading. So our panelists will be divided in the two sessions. But before we get into that, we have our chair for our Treasurers Forum, Mr. Philip Wambua, who's with us this evening. We're so happy to have you here, Philip. Philip is also the GM, Treasury, ABC Bank. You all know him. He's the one who leads the Treasurers Association from the front for such a long time, and we're so happy to have him. He will be giving us some opening remarks just now, and then we can get into it. Thank you.
Good evening, treasurers. Good evening, SEI. Good evening, KBA. Dr. Tiriongo, nice to see you after a while. So, on behalf of the Treasurers Association, I would like to congratulate SEI leadership, Andrew, Malaika, and the rest of the team, Philippa. We always work with them because of the meetings with Central Bank. So whenever there is meetings to be called for, I work a lot with the CI team. Otherwise, for my day-to-day job, I work at ABC Bank. And before I worked at Bank of Africa for many years. So I'm just waiting to retire in a few years. Financial markets all through. I was asked to make some opening comments. So I decided just to see my own way of doing it. And Andrew, I just said congratulations for this event and thank you for inviting me. So I think first is that the choice of topic is very appropriate. It's very appropriate because I saw it's how to navigate the effects of monetary policy easing and physical shocks on global economies. That is so timely. First, for Kenya, it's very timely because yesterday, our central bank took a big decision. I was just talking to Daktari and also Raphael, my co-chair, my co-worker, and it's a big decision. And when you look at it, it is geared towards making money available to the businesses. Because when the rates are brought down, markets are supposed to respond and to respond efficiently. So I think the choice of topic is very timely. Talk of shocks, before we go to the globe, there are also shocks in the country, aren't they? A lot going on in the political side. A lot of things happening. So there are shocks locally, there are also shocks globally. So I think the choice of topic is quite appropriate. And many countries, you look at China, you look at US, you look at Eurozone, you look at South Africa, QE is happening in many countries. So it's a global direction, it's a global action. Economic shocks everywhere, everywhere. Government debts, and it's not just about our country, it's many countries that are struggling with the government debts, and they are growing. Political tensions, you look at what is happening in the Middle East, that's enough to tell you that trade financing, those of you who do international trade, will have a lot of difficulties in doing trade. Oil prices or energy prices, shocks, when you talk of shocks. So the choice of topic is really good. Inflation and central bank policies, ours happened yesterday. Climate change, this is a big one. I work with the communities. Those of you who don't know, I teach, I hatch chicks for women and youth, and I train them how to keep chicken. And I do it well. The reason is, unless we find ways to mitigate against climate, the world is going to have difficulties, more shocks. So climate is one of them, and natural disasters. Pandemics, every time we have a pandemic, now there is Mpox, I think I saw another one. So responses, again, very interesting here. Domestic economies really must be strengthened. And I don't speak this to dilute what the panelists will say. I don't know the questions. but I have to just comment based on my background and my experience. Domestic economies really have to be strengthened by countries. We must diversify. I think agriculture is one of the areas that our country can diversify. I come from Kitui, it's a dry zone. So when you look at it, the type of agriculture that is needed there is what is adaptive to the climate change. Things like sunflower, you know, they grow like weed in Ukambani, but you don't find them in the markets. So diversification of economies, and we always say Kenya is very well diversified. Maybe we must diversify more. Fiscal discipline, public debt management, you know our situation. It's a big problem, not only here, even America, they are talking about it. Everywhere, you know, discipline. Monetary policy coordinations, and the addressing of rates. Those of you that we worked with when we were correcting the foreign exchange, when we were talking something like going to 25%, Andrew, of, was it market share or what, something? I forgot this word, 25% of something we were trying to achieve to try to help foreign exchange situation. I think we are better now, but I don't know. You will tell me better the liquidity, how it is. And also boosting international cooperation and trade. These are all important in responses. But I wanted to mention something on the market itself. And the question I have in my mind is, does the market have a role to play? Also, about public debt and all this, but we as a market, I think we have a role to play. Number one is we are the conduit of information. For example, central bank dropped the CBR, so we are the conduits of information, and we facilitate capital flows based on us being that conduit, because we are all interconnected. The financial market is interconnected. But for the market to be efficient, for us to be a good conduit, first we must have free price discovery. These I've always talked with central bank during meetings, Rafael knows that. Because unless foreign exchange, you can discover the price freely, then you cannot be a good conduit. How will you be? Because somebody will bring money and they don't know when the fixed income market doesn't work or work properly. So I think we need to see price discovery, highly liquid markets, that's what we need, and diversify the products. You know, when I joined many years, I think some of you are not born, and after KU, I went straight to a bank called Bank in the Suez, and I went to dealing room after 4 years. We were 3 only, and we did quite well, a lot of money, because we were dealing with multinational customers. Then we started forward markets, we started swap markets. I think we were starting derivatives. I don't know what happened to derivatives. Maybe the panelist will tell us. But we must diversify the product range if we are going to be a good financial market. And we must be highly efficient. You know, I always tell my lady farmers and youth that unless you have high efficiency in whatever you do, and you must do watertight. If you are keeping chicken, you must have a watertight program. You cannot have chicken and you have a dirisha somewhere. The predator comes at night. If you are to give a protein and you are giving starch every time, you will not go far with chicken farming. So I think the main issue here is to say that we must embrace efficiency and we must fight for efficiency as a market. And this is to SEI and the team and also to the treasurers. So through our financial markets, we have interest rate actions, asset price actions. With good response, the bond markets should have responded by now. I didn't check, maybe they have actually, but they should respond quickly. If they are not responding to the decision by the central bank, then you are talking about efficiency issues, exchange rate actions. So I think just to wind up on what I'm saying is that we have a big role to play, capital allocation, liquidity. We must be there as a conduit for liquidity, risk diversification. Clients want to diversify risks. And our market is a price signal. We are we are on the front so that we signal prices, if it's asset prices, when decisions are taken on interest rates, which are supposed to make, avail more money, ideally to the business community. I would only challenge that the only reason that why we don't have maybe this type of quick effects, maybe because our markets are not deep enough. So I would urge that we consider depth and that we build the market together. So with those few remarks, Andrew, I want to take this opportunity to thank you and to welcome you as well. Thank you very much, and God bless.
Thank you, Philip. Thank you for those good insights and perspectives as well. So this evening we are graced to have with us expert panelists who are thought leaders in their respective fields. In the first session, we will have the first session that will be we will be discussing perspectives on macroeconomic developments. We have with us Dr. Samuel Tirongo, who will actually be the moderator for the first session, and we are so happy to have him with us. Dr. Tirongo is Director, Research and Policy at the Kenya Bankers Association. We will also have with us in the first panel session, David Rogovich. I hope I've said that well. He's a Vice President, Senior Credit Officer, Sovereign Risk Group at Moody's Investor Service. And we'll also have with us our dear Raphael Agong. He's our Group Chief Economist and Acting Group Director, Global Markets of NCBA Group. So those will be our esteemed panelists for the first session. The second session, and we'll go into that again once we get there. The second session will be discussing the topic of global markets and trading. This session will be moderated by our chair, Andrew, and the panelists in the session will be Gashara Nganga. He's Director, Markets Head and Treasurer at Citibank Kenya. We will also have Stephen Langat in the group, in the panel, Director Treasury, SBM Bank Kenya. And we will also have Daniel Gashau, Director, Head of Treasury, Equity Bank Kenya. So we're really happy that you graced our occasion, panelists, and without too much ado, we will just go into the first session. Thank you.
Thank you. Thank you very much for that introductory session. We have the pleasure to host the first panel today. My name is Samuel Tiriongo from Kenya Bankers Association. I like to introduce myself as a friend of the ACI. I work hard to keep the friendship alive. Today we are privileged to have two experts in the field of macroeconomics and global markets, and maybe you can confirm. David, you can hear me? I know David is dialing in online. David, if you can. So as he comes on, KBA prides itself in having a very cordial and collaborative relationship with Moody's. And we do this for purposes of hosting events that help shape discussions and bringing best practice as well as global cases. And maybe at this point, allow me, as David sets up, is to really market an event that is coming on the 14th of November, Moody's East Africa Banking Briefing Session that happens here in Nairobi. So again, please mark your calendars. There is an event on the 14th of November. So David, if you can hear me, please unmute. just to confirm that you're on.
Hi, Samuel, do you hear me?
Would also love to see your face.
Hi, do you hear me okay?
Yes, thank you very much. So allow me now to do the formal introduction of David Drogovic. He's a Vice President, Senior Credit Officer in Moody's Sovereign Risk Group. David has been a lead and a backup analyst responsible for a number of sovereign and supranational credits in Africa, as well as in Latin America and the Caribbean. Previously, David's prior experience, which actually runs back about a decade ago, is that he's been working at JP Morgan, Nomura Asset Management, and Robini Global Economics. So we're so privileged to have David today give us perspectives from a global market space, and would host a presentation that David would make. Then after that, then we will have Raphael provide a local perspective on the macroeconomic situation. So David, you're free to make your presentation, and then we will get back to you with a few comments, questions, and any other additional elements of interest, particularly in this session. Thank you. So in the room, David, just for your sake, is that we have a banking industry global markets practitioners, and feel free to weigh in on any aspect affecting global markets, because that is the team that we have today. Thank you. David, over to you.
Well, thank you, Samuel, and thank you everybody for inviting me to this this forum here and for letting me speak. What I've done, let me just introduce myself first. I'm David Drogovic, so I'm the lead sovereign analyst at Moody's for the government of Kenya, and like Samuel said, for several other countries across Sub-Saharan Africa and Latin America. What I plan to do today was to go through a few slides giving a macro overview of how we see sort of the global economy playing out, how we see growth in advanced economies and major economies, and what our views are on inflation and Fed monetary policy or global monetary policy, and the implications that may have on emerging and frontier markets. And I'll just touch briefly on Kenya at the end. I think the theme of tonight's discussion, monetary policy, fiscal consolidation in our public debt in a world of external shocks is appropriate both for Kenya and for the global economy at large. So I'll go through just in a few minutes our view, our narrative on the global economy. You can see on the screen, hopefully, how we see growth, our views on inflation, and sort of the key risks. And what I would say is that growth is stabilizing across most major advanced economies across the G20. We see some slight variations, and I'll go through this in a second. But we see the easing of monetary policy, sort of allowing a continuation of the cyclical recovery. And by 2025, barring an unforeseen shock, we would expect that for most economies, or for the global economy, we would be growing at close to potential. Again, a key to this is policy normalization by major central banks, and kind of threading the needle, so to say, with bringing down inflation without really bringing down growth too much. I mean, the Fed's already started to ease monetary policy, and now we have sort of a coordinated monetary easing across most advanced economies, or most central banks in advanced economies, that again should be supportive for financial conditions for global growth. And I mean, of course, everybody has a baseline scenario for growth, and then for inflation and monetary policy, and there are risks, and I'm sure that you're all aware of these risks. We have conflicts ongoing in Europe, in the Middle East, potential in Asia Pacific. We have U.S. elections, which will have an outsized impact on the global economy, and we have this trend of global trade protectionism, of governments being more active with the use of policies to support in certain industries, whether it's for national security interests or otherwise. And as I think anybody, as we all know, when you're studying economics in graduate or undergraduate school, their role is output costs and welfare losses when you have trade protectionism. And so it's a matter of us assessing the degree of trade distortions or distortions that are affecting the global economy, and then the output loss that would come from that. So just, I mentioned basically we see growth sort of normalizing, reaching sort of a potential growth or trend growth in most economies. And, this is on the screen here, you can see our average forecast for this is just for G20 countries, but for advanced economies and for emerging markets. And you see that, growth is sort of, steadily, it's declining slightly in emerging markets, and I'll explain why. And in the advanced economies, it's a very small slowdown next year. But we have essentially, if you think of the global economy, in the U.S. growth, we have slowing really in 2025 to about 1.8, which is around trend or potential from roughly 2.5% the past 2 years. So really, the U.S. economy had been holding up G20 growth and advanced economy growth these past 2 years. And so the decline next year is really seeing U.S. growth slowing, and we see Europe picking up, for instance, growing about 1.5% next year. And this is partially driven by an improvement in growth prospects in Germany next year, back again towards trend. In EM, I think important to explain the slight slowdown next year, and this is mainly driven by China, where we have our forecast for growth slowing to about 4% next year. So you could call it a soft landing, I suppose, in China, but clearly, our baseline is for sort of a very steady, slow, gradual slowdown in China. But in other EM, we see growth again, kind of returning towards normal, staying towards potential for most other countries in the G20. Now, part of what is behind that is this idea that now, after getting inflation under control, that we can see central banks easing, and with the exception of maybe the Bank of Japan, where they're normalizing rates in a different direction, we see the ECB, the Fed, easing monetary policy. And so that should help with supporting for growth. We've gone from a period of tight financial conditions or tight monetary policy or restrictive monetary policy to one where now it's beginning to normalize. And that should offset sort of the weakening in the U.S. labor market and the drawdown of savings in the U.S. For U.S. consumers, for instance, and help support this soft landing narrative. You can see here as our forecast for the 10-year Treasury is a proxy for borrowing costs for the Fed funds rate, ECB refinancing rate. And you can see the forecast period going out through, we have mid-2026 here, for the Fed funds rate going down to around 3%, the 10-year Treasury at around 4% in the medium term, and ECB refi rate a little bit lower than that. What this means for financial conditions of the financial markets, our expectation is that with the Fed now easing, that there will be a slight weakening of the U.S. dollar on a trade-weighted basis. So if we think about for emerging markets and frontier markets, a slight that should be slightly positive or favorable for their currencies, and that could give room for central banks to cut. We've seen yesterday with the CBK cutting rates, but continuation of the Fed easing cycle with growth still remaining steady or close to potential should be supportive for central banks in emerging and frontier markets. But one thing I would add here before I go on is, even if you look at a forecast for the 10-year Treasury rate, and you think about what this means for borrowing costs for emerging markets, and to use Kenya as the example here, right? If you look back in mid-2014 in the chart, you see where the 10-year Treasury yield was. This is when the government issued its first Eurobond. 10-year Treasury at around 2%, expectations for monetary policy to remain loose in the U.S. or to policy rates to remain low, versus now 4% 10-year Treasury forecast. Even if you assume no change in the risk premium on Kenya as an issuer, you're talking about 200 basis points higher borrowing costs. So issuing a 7% a bond at 7% in 2014 is equivalent to issuing a bond, in our forecasts or time horizon at 9%. And given a higher debt burden that we'll talk about in a second, this will have implications. Even if we are seeing a normalization, rates will be higher than they were in the past, and that will have implications for sovereigns across the globe and for their ability to consolidate fiscally. So here, just to touch on some of the risks, I think the biggest risk over the forecast horizon is, a sharper slowdown in the U.S. economy, a sharper slowdown in the labor market, and the Fed sort of being behind the curve in a sense. If you just think about the last 2 years, right? We haven't really thought much about the Eurozone growth being relatively lackluster when you think about global growth, because the U.S. economy had sort of propped up or offset that, and growing at 2.5% kept or maintained global growth at a steady pace. So the U.S. has an outsized importance in the global economy. As does China. So that would be the second risk in terms of a sharper slowdown in growth in the U.S. or in China. Risk of stagnating global economic financial integration, something that's related to trade policy, to protectionism with U.S. elections this year, and the outcome of that could have significant impact on trade relations with China, with even U.S. neighbors like Mexico, Europe, and globally. So that would be the second risk, and then of course the geopolitical risk. We see periods or bouts of escalation in the conflict in the Middle East. Same with the Ukraine-Russia potential for more difficult relations with China in post-U.S. elections. All those go through just now a few slides. Just that's our global picture. But I'll go through a few slides on what that means for Kenya in the context of the global environment where growth is normalizing, monetary policy going from restrictive to more to normalized conditions. Clearly, since 2014, when the government issued its first Eurobond, we've seen a steady deterioration in Kenya's credit rating, driven by, these two factors have been the same for as long as I've followed the country, but it's driven by fiscal consolidation and fiscal prospects and liquidity, rollover refinancing needs. That's why Kenya was a country that was potentially perhaps more vulnerable to a tightening of global financial conditions, given its debt structure, given the amount of debt it has coming due, the need to borrow externally, means that Kenya will be more exposed than other countries were to shifts in monetary policy by the Fed, for instance. I would say that for Moody's, a key, and this has always been a key, is that the ability of Kenya to continue to issue or to access markets in the future really rests on your view on the credibility over the fiscal trajectory and the debt trajectory in Kenya. If you think the government can achieve its fiscal targets, bring down the deficit to roughly 4%, 4.2, 4.3 this year, and indefinitely going forward, then you would have something close to our central scenario, that the green line on the left side, where debt will stabilize somewhere around 60%. But there are a number of shocks that could lead the debt trajectory to be on a rising trend. If you think the spending measures that are being cut are temporary, would have to be see an increase in spending in the future. If you doubt the ability of the government to raise revenue, these would all be challenges that would affect your view on the medium-term fiscal trajectory and the government's ability to borrow. But more than the debt burden, Kenya's debt affordability has really been the key credit challenge. If you look on the right side of the screen, the chart shows each country on the charts their interest to revenue ratio, which is a measure of debt affordability. This is for 2025. And the first thing that stands out to me, if you look at this, is that if you look at the ratings of all the countries, they're Egypt, CAA1, Pakistan, CAA2, Sri Lanka's in default, so there's CA, Nigeria, Ghana, Kenya. These are all very low rating levels. The only country that's investment grade is India, and it's investment grade for various reasons. But again, for the most part, you see countries at the very low end of the rating scale. So it's telling you the importance of debt affordability on sovereign credit quality. And Kenya has the 6th weakest debt affordability metric. So what happens in the global economy with global monetary policy and how that feeds through to monetary policy in Kenya, how it feeds through to the exchange rate, through investor sentiment and risk perception, is going to have a significant impact on Kenya's credit profile, more so than a country that doesn't rely as much on external borrowing, or doesn't where the domestic market isn't as sensitive to global conditions. And this, I'll just be very brief here on what I was saying about the reliance on external markets. If you look on the right side, you can see this. It shows you lending from different sources, and I put the IMF, AFDB, and World Bank in colored bars, and then this white bar with the red outline is all other creditors. But you can, let's say that's Chinese creditors, Eurobond issuance, syndicated loans, and you can see before 2020, that was the major source of external financing, and a lot of money was coming into Kenya at that time. That's a period of low interest rates globally. Now, since 2020, that white bar that with the red outline has been a lot smaller. And if you go to the left side of the screen, you can see after 2024, maturities come down, but there are still quite sizable, 3 to 4 billion per year in external debt service alone for Kenya. So maintaining or regaining or maintaining access to external markets, to commercial markets or other sources of financing is really critical, given the debt structure, given the amount of debt that's coming due in Kenya. And here, I'll just end on this slide here. On the left side, you can see the average yield to maturity on outstanding Eurobonds for a select number of countries in sub-Saharan Africa. And I would pose this more as a question than a statement, saying, where will Kenya's borrowing costs go in the future? Will it remain above 10%? Will it come down towards Ivory Coast's cost of funding? Ivory Coast being several notches higher in the rating scale than Kenya, or will stay somewhere in between? And what does that mean for Kenya's debt affordability, for Kenya's ability to roll over maturing debt? And the last part here on the right shows you just gives you a sense of our view of the domestic market and what's changed in Kenya, what's led to two downgrades in the past 2 years, a year and a half. And this has been something that the domestic market has been a very strong captive area market for the government to be able to issue into. But really in mid-2023 or early 2023, we saw a shift here. We saw the cost of funding rise significantly. And at first it was driven by inflation, but if you look at the chart, there's a break, right? The green line keeps going up and stabilizes while the blue line comes down. So your real cost of borrowing domestically has increased substantially in the past year and a half, at a time when we've now seen fiscal deficits being revised larger last year versus the original budget, this year versus the original budget, obviously. And so this is really a key. So if the Fed's easing cycle now allows the CBK to cut rates and bring down domestic borrowing costs, that would provide a degree of relief for Kenya in terms of the deterioration in debt affordability that we've seen over the past few years, and potentially give the government more room to achieve its fiscal consolidation targets. Why don't I should stop here, and I think I'd rather take questions from the audience or hear comments from Samuel, others, and have more of a dialogue rather than continuing with a monologue presentation.
Thank you, David, and for a very insightful presentation and opening us up for comments in terms of what we see on the global economy. Yeah, maybe before we open it up, perhaps you could also weigh in more. I know you mentioned about U.S. elections coming up, and of course, what we worry most about is really what would that mean for the trade policy, particularly U.S. and global economy trade, the immigration policies, because frontier economies such as Kenya rely heavily on remittances and of course industrial production policies, as well as also what does it mean whether you're Republican or Democrat in terms of monetary policy leaning as well as fiscal policy leaning. Then secondly, you also mentioned about the ratings that have deteriorated for Kenya. In my observation, we didn't see a very significant shift in terms of yields on Eurobonds. What's your comment around that, even before we open?
Sure. On the U.S. elections, I think you hit the nail on the head, right? The key risks are immigration policy, trade policy, right? And what that means, we tend to think of the trade policy having more of an impact on some of the neighboring countries that have benefited from, or other countries that have benefited from sort of nearshoring or friendshoring, where countries have tried to diversify supply chains away from China. So we tend to think that the biggest risks to a more protectionist stance would be felt in Latin America and Mexico, for instance. Costa Rica in the past has benefited some from this nearshoring trend. And immigration policy, too, I think is something that it has more to do with migration from Latin America, Central America, more so than other parts of the world, but something that, again, would have an impact on developments, would have an impact through remittances, for instance, in Kenya. It's something that we continue to monitor. We'll see the outcome of the elections. What we've said in the past, really, it's about the policies rather than if it's one party or another winning. This is the case in the U.S. or anywhere else, right? It's not so much the election itself leads to a shift, and we have a view on one party being more capable or not than the other. It's about how does that affect policy outcomes? What's the composition of Congress? And does that give the next president, the next administration, the ability to pass significant legislation? There's checks and balances in the U.S. and the strength of institutions here is something that's been a bedrock to the credit rating in the past. I think from a global perspective or from U.S. perspective, the thing that next incoming administration will have to deal with is really widening budget deficits and a fiscal trajectory that would see a steady decline, a steady rise in debt, a steady decline in the United States fiscal strength, which could have a significant effect on the U.S. sovereign credit profile. We do have a negative outlook on the U.S.'s AAA rating. So I think that for the next administration will be one of the key issues is the budget deficits and how to address fiscal consolidation, need for fiscal consolidation, and to arrest the rise in debt. You asked a question on Kenya's Eurobonds and the yields there. I would say, Kenya is an interesting country. I think because the government went to the IMF so early, even at a time when they had market access, they've been given a lot of flexibility, a lot of leeway in terms of market's perception of credit risks. Because, again, we've seen up until this point, up until the mid 2024, really the government has been able to access more and more funding from the IMF. The IMF has been willing to increase the size of its program, going to exceptional access at one point, the World Bank as well, because the government had been willing and capable of implementing reforms that were necessary from the perspective of the IMF. Whether it was removing fuel subsidies, how many countries have we seen around the world that have not been able to do that? And Kenya did it, and they did it in the midst of an election, right? A lot of the measures on revenue administration, ETIM, stuff like that. Again, the government has shown a very strong capacity in the past to implement these policies, these measures, at least up until the Finance Bill or Finance Act for 2024, when we saw a shift. And that was what led to our change in our assessment of the credit rating, that the government no longer in the current political environment no longer had the ability to implement, in this case, very sizable revenue measures that would ensure support from the IMF and from the multilateral community. And so in the absence of that, they need to borrow elsewhere. There are still options. The UAE is the more recent headline. The World Bank and sustainability-linked bonds is still an option for funding. So there are funding options. And I think the spreads, the yields on the Eurobonds for Kenya reflect that they don't have another sizable maturity coming due that they can point to, say they need to roll over this bond like they did in 2024. It's just more about the size and the magnitude of the amortizations year after year after year, rather than one single bullet maturity. So I think in that sense, maybe the market perception has improved. They still expect the IMF to back Kenya. but that's how we see Kenya's credit risk having evolved.
Thank you, David. And to weigh in even more on this subject, we have Raphael Agung. He's Chief Economist and Acting Group Director, Global Markets at NCBA Bank. His responsibility is really leading the economic and statistical practice at the bank. And of course, he's publicly, he is described as the analytical brain trust for the bank's executive organs, including Asset and Liability Committee and the Executive Committee. So I would want to invite him to make some perspectives from really linking the global developments that we have seen to the markets local in terms of providing now what we can see from this end towards the global market. So, Raphael, you would want to do it from there? Oh, yeah, you can, I guess you can do it from there.
Oh, I need. So, good evening, everyone. So I think in the interest of transparency, I think I should say exactly what happened. I was invited to a panel. You can clearly see it's not a panel. I got here and I was told I need to react to David's presentation. So I tried to listen very intently, and then my notes are all 2 points, because I largely agree with his baseline sort of almost everything. It's in the means, and I think tonally I think more or less sounded more optimistic than perhaps I would have been, but that's pretty good for those of us who live in Kenya. Now, I think two things that I took from him, and so sort of try and domesticate it. I think that's what you want me to do. One is that the external environment is far better than we've seen, or rather getting far better than we've seen in more recent memory, primarily because the Fed is pivoting. Most of the central banks that he's spoken to are pivoting. We're all familiar with that as traders. And so to that extent, possibility or viability of Kenya's access of external financing is much, much more improved, perhaps better than we've seen prior to June 2024. That's one. And then on the, with it, I think the subtext of his note is that the concern is around the fiscals, and more directly whether the fiscal consolidation path is credible. I think that's the adjective he used, and that's a big question, which then leads me to the central bank's, let's say the MPC's positioning last evening, and obviously the governor's interviews later today. So what do we know? I think central banks tend to use a simple sort of Taylor rule supposition to determine what's the appropriate level for the real interest rate. What those of you who study economics, the R star, presumes an optimality in terms of if you're powering all your resources, your factor inputs, all your resources are powering, your optimal growth number is perceived as X. Enough has been what's been put forward for the most part, and then you try and see how far you're varying from that on the one hand, and then you look at your inflation targets as well, see whether you're on target or not, and you calibrate monetary policy. So how would you see up there? Of course, there's lots of criticism around whether the Taylor rule itself is applicable in our context and for most of our economies, but you can vary it whichever way you want, assuming that that's the workhorse that the central bank goes with. Where are we? Inflation 4.6 against a target of 5. Puge was very eloquent yesterday in terms of just the communique.
with regard to the successes there too. And then on growth, we have Q2 numbers dramatically lower than we've seen similar period last year. So you'd argue that directionally there was no brainer, which he was gone. I think a lot of you who provide commentary summarized as much. But I think the question then is the quantum of it, and this is where I'm going to say this respectfully, because I have a lot of respect for the central bank, but this is where I find a lot of things amiss. Now, you're having a fiscal problem, as we all know. You have the finance bill debacle, the back of it, the political economic context has gotten even worse. We have an unprecedented impeachment process going on. Constitutionally, I think that's a very good development in terms of just, and this is not politics, but, and I think will be very good if the Gachagua team, for instance, take it all the way to the to courts. So for our jurisprudence, I think that would be a good development, but I digress. So you're having, on the back of the fiscal problem, your honor forces you to do a couple of things that are untenable for the public. Your political economic context has changed dramatically, still ongoing, and then the fiscal problem stays. So I cannot see how you answer that with a revenue-led, primarily consolidation path. So I'm answering to the credibility question. So I'm a bit doubtful regarding that. Yes, I'm aware that from a liability management point of view, David's spoken to it. There's a couple of rabbits that I think we pull out of the Middle East, and those are good developments. We do know there is a standoff with the IMF. That's fact, although Thuge was pretty hopeful that things should come through by the end of the year, as it were. So if you have that, I think the only path I see is a long-term one in terms of addressing the that fiscus in a meaningful way, because it's what's holding your cost of borrowing. He spoke to it, and potentially actual dole out of credit to the private. I think Philip also mentioned that in his remarks. It means you have to go back to the old path of growth. So growth is so essential in terms of prioritization. And I think if you're growing at 4.6%, by Q2 numbers, likely lower for Q3, you have to factor in this street protest impact on that. And then you have the last quarter. So definitely nothing above 5%. I think we can agree on that foreseeably. Then if you look at all your revenue sort of pockets, you have to go back to growth and tax on products as a potential path. It's a long-term lead, but I think you've got to be more foresighted in doing. So I'm wondering the timidity, and I'm saying this respectfully, of a 75 basis cut. I think there was a huge opening for a much, much sharper drop in rates to be able to address growth, which I think is in peril for the reasons that we understand. And it seems to me that, therefore, that on the external side, although, as David points out, much more improved, we've seen it in relative better performance of the Kenya shilling. I don't know that it's performance on, but anyway, it's a standstill at 129. As a matter of fact, if the central bank wasn't boosting reserves as Thuge has announced this afternoon, probably rates could be lower than where we are in terms of the exchange rate. So I'm a bit lost as to why we couldn't be bolder and try and drive cost of borrowing much, much lower. The dislocation that I would see, or the rupture potential, is on the exchange rate. And even if you factor in the exchange rate pass-through onto inflation, which should be his secondary concern, I think, you still have a significant lead time to be able to recalibrate policy. So I think the central bank, consequentially, I think they still have one iteration in December, ought to consider even further lowering of rates in terms of just the pivot. That's what I see. But in terms of the priorities of the day, I would agree in entirety that obviously the key risk on the global side is, as is pointed out, sharper growth from the US. The Fed was actually, surprisingly for me, very bold, which is what I thought our own team here would have gone by. So the jumbo rate cut was delivered within the context of just 2 months out to an election. You'd argue that especially given the dominance of one candidate, just voluble nature of one candidate. I have thought that the Fed ought to have made the decision in a lot more tamer sense. You did see the political football. So in that sense, the Fed really did, well, let me say, not surprised, but I think acted pretty boldly. So if you say that the external risk, rather the immediate risk to the path or the outlook that David has provided is sharper slowdown on US, I would agree, but from us taking out from the US, I guess, looking into Kenya, we all want to handicap the election. And in that sense, I think what's more relevant for us, for markets and economies more directly, is potential platforms. So I think Kamala Harris did release her comprehensive platform. You'd argue, I guess, and David has been very eloquent on this, in terms of what matters is immigration policy and or trade, or protectionism as he called it. And it's arguable whether anecdotally or just based on what people know of the candidate Trump, his talking points have been pretty much on the far right with regard to those two. And so to that extent, I think you'd argue that emerging or frontier markets, Kenya taking in, that's what we presume. I think the prediction markets are putting the money on Trump for now. And so whatever you want to make of it, that's the external environment that Kenya potentially could confront post-November 4th. I think materially, because it's the monetary policy part that matters, I don't think the Fed will be deterred. So in that sense, I also think I agree with David that we will proceed with a much safer bid. I think so in terms of access, slightly better, and at the rates that I think is pointed to. Yeah, I think from that, aside from that, that would be my reaction. I hope I spoke slow enough to be heard. Thank you.
Thank you. Yes. Okay. Thank you. Thank you, Raphael, for that perspective. And I think David did mention something about Kenya being an interesting country. And sometimes we do not respond the way it's expected. Sometimes things have been argued that we are misaligned from fundamentals. And many occasions, even now, I doubt whether the exchange rate has moved, and we are going through an impeachment on the second in command. And it's an interesting country in many perspectives. Looking at the domestic economy, I think the governor also did mention about the fear that the credit market is contracting too fast. We are at 1.3 growth in credit. NPLs at 16.7. And the worry now is how do we get back to our double-digit growth in credit? And of course, because of that, I think there are serious revisions on the growth outcomes. Now I think about 5% is projected. So without a quick reversal in credit growth, we are likely to see economic growth going down to below 5%, and I think that becomes a great worry. Now, the other worry associated with this is rigidities in the market. Are we likely to respond to the cut, the 75 basis points cut in the interest rate? Are we likely to quickly respond so that we are able to support a stronger growth for 2024 is the question. And I would want Raphael to weigh in on that. The other aspect is exchange rate. And of course, we've seen downgrades on the sovereign credit rating, and that has been translated to a number of financial institutions that have strong exposures to the sovereign. How do we see that playing in the banking sector? And particularly now that we know about a quarter of the private sector loan book is FX denominated, what does that mean for credit growth and particularly for banks that are strong on FX denominated loans? Because we're seeing there's a stronger bias for the exchange rate to appreciate further. But again, we are on the interest rate cutting space. What does that mean? So you could weigh in before we open it up for questions and comments from the plenary. I hope, David, you're still on? He's on, thank you. So, Raphael, you could briefly weigh in.
Thank you. I think it's so much better seated. I feel much more comfortable with things. Well, so rigidity. So I think so Samuel is an economist, as we all know, and the vernacular tends to be very sometimes very complicated. I think what you're asking me, let me rephrase your question in a language I probably understand. We have a rate cut that was granted yesterday. Do we see that being transmitted through? I think your question is not only topical, but also in the governor's mind, both if you listen to him, but also just in consequent interviews, I think he'll be expressing the same. So we do have a new monetary implementation framework. I think it's not new now, but I guess we could still talk to it. That succeeded in very, very many ways. Opting to use the overnight rate as the target operating model and, of course, tying the policy rate to that. We've seen that volatility on that and basically the signaling and driving outcomes has been more tighter then. But it's an open fact that the further out, it doesn't transmit still as you would have thought, or at least as effectively. In the more charitable view is that it's not actually a monetary policy problem per se. It's actually, again, coming from these old ugly animal, Kenya's on the fiscal side, which is single issuer, the sovereign, primarily everything, and that determines everybody's investment per view and what have you. And given where they are borrowing at the levels that you have seen. So in that sense, you still have, there could be some greater tightness. I do know, and I guess thanks to Philip and the conversations we have with the central bank, there's lots of work in trying to just see how you drive efficiency around the transmission mechanisms across the curve. So that probably will come through. I think they did get into, interestingly, one-day reverse repo. I think you saw that. So it tells you they're trying to think about the transmission mechanisms a little more deliberately or thoughtfully. I'll see that. But the straight answer is we've seen, and I think some of the paper or work that you've done at KBA reveals there's greater efficacy of transmission with yourselves, and as bank on the left-hand side for deposits, you'll see that reprice pretty quickly, much less on the right-hand side, which is what you'd like to see. So there is of course, banks have adopted different, the central bank is approving risk-based pricing. Well, I don't know where everybody's at with that. So you'd assume that some of this, from an agency point of view, have been factored into most of banks' ALCOs, and I guess the expectation is if you do have a base lending rate, at a minimum, I think that will go. Gashau and your ALCO, I think you tried to provide some leadership in this regard after the 25 basis point drop. So yes, from a signaling, yes, I don't know whether actual real rates will move as fast. I'm hopeful that it does. But perhaps let me talk about why it should than whether it will. That's a harder question. I think it should primarily because of the numbers you point to, which is credit has stalled. When you can play with the exchange rate effects on the numbers that you point, but the reality is on Kenya shilling, it's credit has stalled. But even those who can be able to access credit, it's significantly punitive And I think it's going to be very hurtful to growth. So it's exceedingly essential, and which is why I was arguing for our own version of a jumbo card. The prices can respond the way they want, but and particularly the exchange rate. We've been to 160s and sometimes peeped at 200s, and yeah, there was the whole dislocation problem. But frankly speaking, there's a bit of path to have been a bit more, to gamble a bit on the side of growth. So I think that there should have been even a greater signal. I know it's been loaded roundly in the mainstream media as such a big cut, but I think there could have been bigger, would have perhaps shocked us more into driving what you want to see. Now, I've gone on and on in a winded way, so I forgot your second question. What was it? The exchange rate?
FX denominated facilities, what does that mean? Now rates are coming down and there's an exchange rate appreciation bias in place. What does that mean for quarter of the loan book for the banking sector?
Yeah, that's it. So that reprices off the whatever basis risk any institution takes. Primarily, of course, we now have SOFR. And if your reprise cadence is whatever it is, it will factor where we are with that sort of benchmark rate. So I think that reprices automatically in terms of foreign currency lending. That's what I see, which is why the wisdom of going for that for most borrowers has been great. Now, the exchange rate thing is sensitive. I mean, we've been in difficult times where we've had fights. Thanks, Chair. So I don't want to be controversial in any meaningful way, but I think the exchange rate ought to move, and I think you always say this, Philip. It needs to move one way or another. The standstill is not better either, because I think there has to be some sort of movement that reflects that nobody knows where demand is coming at or X. But okay, in fairness, if you look at something also has changed with regard to our external numbers for sure. I guess the big animal is G2G. If you look at the level of reserves at just north of 8 billion, if you work it back to see the extent of demand on a monthly cadence for the country, I mean, you know where the number is, and then you see this whole ecosystem of G2G disrupting that, because almost 2/3 of that, of course, is energy, as we all know, in terms of Kenya's takeout. So if you take from a price component in terms of us where energy prices are, but also just that move around the G2G has changed the cadence of the number. So you could argue that, yeah, we can understand why a lot of us are struggling with sort of the exchange rate expectations, and the central bank, given their experience, of course, wouldn't want to wreck things up and are going to try to be very cautious with regard to any shocks. But I do think that even if you created a whatever interest rate differential now, I don't think the currency would be that disrupted, in my view. So I think there is significant room for signaling even harder and then recalibrate. We have a 6-week cadence. You can always recalibrate if one price is being noisy. That's what policy is there for. So I mean, that's just my views. Thanks.
Thank you. There's a lot of room for further cuts. So I think allow me then to open it up for questions for anything global markets based on presentation by David from Moody's, who is still online, I want to believe. And then any comments, questions on the discussion that has happened? It's open now. There's no way Raphael was that clear.
I didn't invite you to carry on.
No, I think maybe you need to clarify what you meant by 6 weeks cadence. What were you referring to in that respect?
6 weeks. How long does, what's the well, sorry, Kasha, what do you say? Correct, yes, the schedule calendar for the monetary policy. Sorry, my language is terrible, but I'll try better next time. Just the iteration of their scheduled meetings, I would imagine that, yeah, that's what I meant. Thanks.
Does the is at December?
Yes.
By the next meeting.
Yeah. Is it 6 weeks? I don't know. Sometimes I get confused.
It's about 2 months. Eh?
Yeah. So let me ask a follow-up question. In your view, given the fact, I thought it wasn't working. So in your view, and given the fact that you think that the first cut was a bit underwhelming, where will you think a neutral rate for our market will be?
Interesting question. So let me go back to what I said, and this is dear to me because, especially in the last couple of months, just trying to understand open economy macroeconomics, which is the presumption that there is a real interest rate, to your question, that balances savings and investments when all the resources are on cost, right? And then if you go further than that, and I've really been trying, because I've been asking myself the same question. The short answer is I don't know, but I'm trying to tell you why I don't know. They go on to say that you only determine that real rate after the fact. You only know it when you get it, when you get there. In other words, the notion that you have some agreed and decent number of potential of output, full output or optimal output for an economy is mythical. You keep finding it and then you get it out of the fact. So Gashara, I think the straight answer is I don't know. What I can say is I also can't see how you have real interest rates at double digit and convince me that something is not out of whack. Either the inflation number or inflation performance is, we either believe what it is but I just cannot see how that doesn't tell me that there is something that's out of our whack, which is why I was arguing that perhaps slightly lower would be. But the straight answer is I don't know. And I don't think there's anybody who knows. Yeah.
Thank you very much. Allow me to give a round of applause to the two gentlemen. Oh, there's a question, yes.
No, I just wanted to ask Rafael, considering that bigger economies normally have lower rates, currently we are seeing a situation where Uganda are at 9.5, Tanzania are at 6%. How are they managing, considering Kenya being their neighbor and a bigger economy at 12? So I could say that gives you some sort of direction on where the rate should be.
Yeah, I mean, in comparative terms, yes, but you still won't get to a number. You have, where is Uganda inflation at? Sub 3. Or Tanzania, if you believe their numbers, you know where they are. So if you get the regional dynamic and say, okay, that should give you an indication of Kenya being, are you arguing, just so I don't misrepresent, are you arguing that Kenya is too restrictive? Too restrictive. So I have a convert in the sense that, yeah, we need to go much lower, right? I think so. I think if there was an opportunity to go lower, frankly, honestly, and I think I shared with the MPC team these views, it's fairly open. I mean, people can talk about the economy. If there was a chance to have the policy rate lower, it was now. I think so. I just don't. And the worry about the exchange rate, in my view, we have a chance to at least drop rates. That's what I would argue. But I'm sure that in December they'll recalibrate and see what else they're going at. But I agree with you. Yeah.
Maybe just to weigh in also additionally is if you look at what took us to where we are in terms of interest rates, inflation, of course, the fear of inflation, but what's driving that inflation? It's food. So our Uganda does not have extreme food challenges like we do. So their inflation is highly moderated because they have an ample supply of food throughout the year. So because we are exposed more to those shocks, so we will respond to the shocks accordingly. And that's why we have to go to 13%. And when there is good rain, we come back. Again, drought, we go back. So it's, again, what we are predisposed to and what drives our inflation. And it's unfortunate that we have to respond to food supply side driven inflationary pressure using monetary policy too. So it's that we have to control demand when we are dealing with supply problems. But that's the tool that we have. So that explains to a great deal why the differences in the economies is what we are predisposed to.
But you're onto some good money. Sorry, this is interesting. Actually, if you bring out the weather side and food, yeah, perhaps they're right to be a bit timid because the weathermen are saying that we probably had the best run, right? So if I take your argument, Tiriongo, to its logical conclusion, then maybe that's what they're seeing that I'm not seeing, or that we are not seeing. So maybe it's important to be prudent because if you have that, you've got a massive lift-off on the food side. So if that's waning, and they have better data than I do or we do, so let me be a bit more respectful about my critique, maybe. Thank you.
Thank you. Yeah. Thank you. In the interest of time, I know these conversations can continue. It's a Friday evening. And we have another panel session that is coming up, so allow me, as we recognize the contribution by our partner from Moody's. David, you're free to continue to listen in. I know dialing in from the US, you are still morning hours, and you have a long and open day ahead for you. So, but you're also free to exit should you have any other engagements coming up soon after this. So over to you, Andrew, for the next session, or to...
Thank you.
Thank
Raphael,
you.
don't leave. We want you to be able to fire any questions you want to the next panelists as they have for you. So we'll give you the honorary seat. You can stay there for the next session. I'd like to... and thank you for doing such a good job. For those who came late, we had done introductions. We have Dr. Chirongo, who's done a very good job. Thank you so much for that moderation. We've had David Rogovich online, who is a senior credit officer for Moody's Investor Service. So right now we will have David Gashau. We'll have our Daniel Gashau. Daniel, David. Okay, I'll just use last names. Gashau. We'll have Stephen Langat. He's our Director Treasury SBM. We will have Gashara Nganga, Director Market Head, Treasurer, Markets Head and Treasurer Citibank Kenya. And of course, Daniel Gashau, Director, Head of Treasury Equity Bank. Please come and join Raphael on the podium. As we go into the next session, it will be, the next session will be moderated by our chair, Andrew, and the discussions will be around global markets and trading. Thank you.
Good evening. I hope you're all taking notes and not getting dazed by the many jargons that are being thrown left, right, and center. Are we awake? Al-Nur, hello? So the next session will be just to break it down further. The discussion is just around global markets and trading, which is what most of us do. So feel free to engage. It's a free space, so take notes, and if you have a very burning question, please feel free to ask. So I'll go straight ahead. I'll start with Gashara, who's next to me. So with monetary policy easing now gathering pace in developed economies, do we expect to see increase in FDI, that is foreign direct investments locally, considering that our local interest rates are still in double-digit levels?
Okay, maybe how I'd like to start is by trying to answer Raphael's question. Raphael asked why we are where we are in terms of rates. Given how the other fundamentals look, inflation is low, the currency is stable, but you must remember why it has taken us this long to have this fast cut, right? The central bank was waiting to see action from the Fed. I think inflation hasn't turned now. I think the currency hasn't stabilized now. But up until they saw that bold move from the Fed, that's the only time they could come and say that we are going to, they are going to also start cutting and start cutting aggressively. And the question then becomes on the back of that is, given how, or given this dynamic, how much more have we become dependent on what happens globally compared to what happens locally? We become hostages to the global market. I think it's part of the integration because as markets evolve, markets play, or other countries start to, as you trade more, you start having a bigger role in your economy. And especially if you look at where we were, say, 10 years ago, there was integration that happened even faster. And how did that happen? By all of our emerging markets going into the Eurobond space. And then what happens is that market ends up being the gauge of investor confidence, and it ends up being the gauge of your risk credibility. I think it moves ratings as opposed to the other way around. And given that we went from that space, and a lot of African markets, if you look at now a country like Kenya, I think our debt is 50-50, 50% foreign currency, 50% local currency. And because of that, then not only does the exchange rate play a very big role in it, but also it also means that when something happens out there, it has an outsized effect. I always mention that if you, about 3 months ago, when Hezbollah attacked Israel, the previous day, or the previous, actually that Thursday, because that happened over the weekend, that Thursday we had the biggest drop in rates. So T-bill had come from 16 to 15.5, and everyone thought it was the beginning of a trend. Then over the weekend, the attack happened and risk markets went crazy. Oil shot up, the dollar strengthened quite a bit. And everyone, even here, got spooked. They were like, is it because rates have come lower now, so that's the reason why the currency was under pressure? I think that's the day we came from, I think, 130 to like 134. And this just goes to show this integration that I'm talking about. And then that means that when the global economy is better, sometimes it starts to look as if it starts to trump local dynamics. Then after that, the second question is, what idiosyncratic risks do you have in your country that separate you, say, from a Uganda, from a Zambia, from a Nigeria, that then people start being a bit more wary. In my previous life as a trader, I knew someone who used to trade rand, and you'd think that being a bigger economy, a lot of the things that happen in their market will end up being a bit more important. But he told me that whenever he'd get an alert on his phone, because he had set up alerts for whenever the currency moves, the first thing he'd check is, where is the US 10-year treasury? Where is oil? And that was where was euro dollar. You don't even start looking at your news to see if Gachagua has been impeached. So the first thing is what is happening out there, and then that becomes more important than what is happening in your local markets. If the Fed was to come and say that we are going to start getting into another rate hiking cycle, all these bonds that I'm sure all of us have been very happy about rallying over the past couple of weeks will end up going the other way around. because we have a lot of portfolio flows into the market, and because this ends up then even driving what happens in local rates. So because over the past 2 weeks, the IFBs have been rallying, the rest of the local cover has been started to rally, everyone starts to get a bit more bullish. So I think we've gotten to a point where, as I say, that overhang becomes more important for the next, say, 18 months, as the Fed is continues to be on this rate cutting cycle, as the ECB continues to be on this rate cutting cycle, we then have space. And then this is where, to Raphael's point, the central bank needs to be a bit more ambitious, because when I was asking about the neutral rate, you would think that, so if the Fed only cuts by 300, we also do only cut by 300. Is 9% the level at which we say there is balance, that we'll have private sector credit growth and inflation will not be a problem? Maybe it's lower because of also the sustainability over the next couple of years. But then as we go through this journey, it's now for them to see and calibrate and say, this is where we want our economy to be, because they have that room. The reason why you haven't had that room over the past few years is oil was spiking up. With oil at 120, we're all importing countries. Second round effects of that into inflation, they don't give us as much room. So in as much as sometimes we think we're insulated, I think we are much more connected, and it's becoming even more important. So maybe sometimes when you wake up, don't look at your local paper, look at what's happening out there. It could have a bigger impact on your day than anything else.
Thank you very much, Gashara. I think you articulated very well. But I probably want to ask you a question. So do you think Kenya or countries in the region or countries in Africa have learned their lessons, given what has happened, all these vagaries that we've faced, especially for the last, say, 4 years since the onset of COVID till now? Do you feel that we are seeing maybe policies being put in place to address issues of how do we incentivize exports? How do we deal with things like agriculture? Do you feel a lot has been done to insulate ourselves from these shocks?
I'd like to say yes, but unfortunately, you're caught up in the political economy. And the problem is that lessons are not learned up until there's a crisis. And even in terms of, I'll give an example. Say like this issue of taxation and continued taxation. You'd think that because there was a crisis and the finance bill had to be reviewed, that then you'd say there's a lesson that was learned and would not start pushing for more taxes, right? You'd think that because in June, we're all worried that we're going to default on the Eurobond, that the people will come and say, okay, now let's not do any more Eurobonds because there was a risk event that happened. But I'm sure either by next year at a time like this, we will have done another Eurobond, maybe even 2. So I think people will always look, or rather politicians will always look for the easy way out. And in as much as we think that we are led by bureaucrats, they're also appointed by politicians. So there's a huge influence on how the economy works from that aspect, and they don't learn that lesson. I think lessons are only learned through much more painful ways. I can tell you Ghana is not going to default again because of what they've gone through. Zambia have learned their lesson, but these other milder lessons, they don't stick. We just go through in 1 year, out the other. In a few years, we'll get back to the same cycle, have the same problems. Look out at the playbook that we used last time. Will it work now? And then we keep going on.
Thank you very much, Gashara. And I hope you're taking notes. I hope you've heard what he's saying. I think African governments and especially African governments have this knack of not heeding from lessons from others, and I think locally the jury is out there. I don't think a lot has been done to address this, insulate ourselves from these shocks. So let me shift gears a bit, and Daniel, the next question is going to be yours. So what is the likely impact of the ongoing conflict in the Middle East on local currency, or even regional? You can touch on it. And how can Kenya insulate herself from this adverse, from such conflicts in terms of how do we address our exports? You know, we do export to some of these countries, Iran, tea, in other countries in the Middle East region. So how do we, what is the likely impact, and how do we insulate ourselves?
Thank you, Chairman. Maybe just going back to Gashara's starting point. I think it was October 7th when the first attack happened. And we have, I don't think it's just African governments that don't learn. We have actually seen challenges happening even at the global level. We are now in year 3 or 4 of Russia-Ukraine. We are in year 3. The world seems to have moved on broadly. So we had the shocks around that time that largely was around supply. That period was maybe exacerbated further by the fact that COVID concerns are also around the same period. But you'll find that broadly that product actually still moving. And from the farms in Ukraine, from the farms in Russia, oil fields, there's still product moving out. Now, the concern I have is that we seem to have, again, insulated that problem towards that particular region. So there's a lot of input that's coming in there, but largely talk. Forces that can very easily put their foot down and actually bring down the conflict in that region seem to more or less give them a side eye and just watch as the escalation of conflict happens. Now, to your question as to then the impact it will have to let's start with Kenya. We export, like you said, about 10%. So out of our export earnings, about 10% of our export earnings actually is to the Middle East, and it's along things like tea, like what you've mentioned, among various other products. Let's also focus not just on what we are exporting there, because in the event that the conflict there escalates, right now it's very limited towards that particular strip. We have seen Gashara's friends, the Hezbollahs, start to now throw in their missiles. They want to come into this space. Now, the challenge will be now an escalation of the conflict that now draws in more countries within that space. Because now you can imagine within the GCC region, having now players come into that space, taking sides. Towards the western side again, having more, if we have the US warships are on the ground, but you see, they have not yet done much other than stop attacks against Israel. Now, an escalation of conflict will now be a worst case scenario, because then it will suck up the Middle East into now camps, and that will now start creating challenges for us properly. Because right now, I believe we are not yet having economic impacts as Kenya and largely East Africa, but an escalation of conflict in that region, drawing up the countries around Israel, will now definitely put into jeopardy Kenya's prospects. And look at it from 2 ways. Like I mentioned, we do about 10% of our exports into that region. So we already have our problems right now with tea. One of our it's our second largest export earning in that place. And we are struggling in terms of stockpiles here. Our markets have been dwindling ever since COVID. So that will put pressure in terms of our foreign exchange earnings. But if you look at it from the right-hand side, you will find that our largest import is petroleum products. And our source market is within now the wider GCC. Now that will be a terrible position for us, because barring the Middle East, so assuming that Middle East lights up, I don't know where we'll get our oil, because the next best option will be where Russia. We have embargoes around there. We probably will need to start again looking for product out of US. And by the time the Middle East is sizing up in terms of supply, we will be talking about oil trading at levels of anywhere between $150 to $200 per barrel. So that now brings back our FX pressures. Now, I'm with Raphael here that our currency is likely to be stable in the short term. There has been a support that has been coming in from, I think, the only financial market player that is not in this house. And barring that, we probably will have been seeing the shilling a lot stronger than where it is right now. Now, I saw the comment by our Moody's colleague, and it did speak to the fact that, you know, the global risks that come from now geopolitical risks are not areas that we can easily map out and to the impact it will have. But for where I see it will definitely be severe if we're able to, if it sucks up more countries within that region. Thank you.
Thank you very much, Gashao. Maybe to our next question, with the expected decrease in interest rates on the back of monetary policy easing, what is your take? What is your expected outlook on, let's say, dollar shilling, at least in the short term to medium term?
I shall go to one question. Okay, so we, as much as yes, we need to look at what is happening in terms of the global rates, we cannot afford to ignore the impeachments happening here, because we have not separated our political conversations with the economy. You will find pockets where we have the dollar currently weakening, but look at case, stable. Can we link it to macroeconomic factors on their own? There are hands and insinuation that comes in and helps to drive that. And I'm really hopeful that these engagements by the players in this room will actually help us move towards taking our position in terms of driving conversations around, especially matters to do with FX and interest rates in this marketplace. The rational conversation will definitely be that as the easing stance comes in, access to credit, we got, and Dr. Tirongo mentioned, our private sector credit growth is in the low single digits. Consumerism is struggling. We think we have gone through savings across the broad-based population. So we do not have that spending power like we had 2-3 years back. So the expectation will be that if the transmission comes into play, we definitely need more jumbo cuts for transmission to readily trickle down. We do need to see how that will support the private sector credit growth. We need it to come to levels of, I think we've seen it at levels of about 12% that was now stimulating growth at 5 to 6% levels. That will have a knock-on impact because there's more cash in the pocket. I don't have to buy my suit from Gikomba. I can now order my suit from that place these guys buy theirs from. And that now is where the pressure point now will likely come in. So I don't see case strengthening much in the current context. Our imports are down about 5% so far. Our export earnings, I think we are up about 1% so far year to date. We have seen a lot of drivers that should ideally be supporting for a stronger shilling, but we do know that we are instead building our reserves, so let's build our reserves. So short-term case stable, we do need significantly higher, or rather wider cuts to actually put in the stimulus that the case market will require. So we can close our eyes and see how we're going to close the year.
Yes, please go ahead.
And maybe this is for you and Raphael, because I've had both of you speak about the current high rates and it being an impediment to growth. If you're to rank, or if you're to give it an importance, how will you, or how much weight will you give to the current levels of the policy rate as being an impediment to growth? So if we were to say, as a lever, if you are to come from 12, say, to 7, how much more will you expect growth to change by? Or do you think there are other factors then that have a bit more weight, and then so moving the policy rate might not have as big an impact as you think, or as we seem to believe it would?
So to start off, before the brains come in, there is definitely an impediment that has come in from the high cost of credit. But I believe that's one of the factors that has actually impeded further credit access. And a lot of us sit or support ALCO conversations, sit in our EXCO discussions. Our risk appetites are recalibrated on a couple of metrics. And while the cost of risk at segment level or at client level will actually impact what we are looking to do, there's also, macro events. So we're looking at, I think you mentioned, Dr. Tirong, right now we are at about, 16% NPLs across the industry, 16.7. That is putting a drag on risk appetites across, because, how much are we willing to then put out that is guaranteed to, drag down our capital and as well as our profitability. So it has a part to play, Gashara, from where I sit. I would need to consult in terms of the quantum, or what is the level of correlation or causation that it has towards private sector credit growth. From where I sit, it is a major impediment, because if my cost of doing business is challenged by my financing costs, then I will not expand my business. I will not take up that much needed facility to then, expand to a different market, expand to a different business line. There is a lot of engagements that when I go out to the field, customers are watching and waiting. What are they waiting and watching for? That's maybe the question.
Okay, so I think your question to Gashara was on FDI. I don't know if I think yes, it was. Maybe answer it that will be more FDI, just for the record. Just taking a piece at you. I'm so prioritizing what for what. What's absent is labor market numbers. We don't KNBS does very good work generally, but on the labor side, we don't have very good numbers, okay? And that's a critical component in terms of just immediate macroeconomic objectives. So in the absence of that, I would say that my argument for prioritizing growth at every cost, or in actual fact, to the detriment of everything else, including noisy prices, whether interest rates or exchange rate or whatever, is primarily to address the fiscal problem. I'm arguing for growth as a panacea to higher revenue, because the only reason why you can't, for instance, have lending rates closer to the policy rate is because you have to borrow domestically at the highs of where it is. So it tells me that you have a revenue challenge, and then these Gen Zs have made it impossible for you to tax more. So you need a bigger tax base to raise revenue, which is why I said it's not an immediate cure, so it's an immediate palliative, but if you prioritize growth, perhaps tax on products as a line may give you something more meaningful. So I'm actually prioritizing growth singularly as a revenue response. Otherwise, the trade-offs are pretty clear. Everything ought to be in play. Kenya we've not seen 4.5% growth is what I think we'll achieve in a long time, except for the COVID contraction. So that starts worrying me in terms of just the revenue implications, because everything rests and falls on that funny number, output services. I think that's where it begins. So for me, I'm arguing preemptively for strongest buttress on growth as perhaps the revenue solution, assuming that there is no appetite for whatever agreement we'll get from the IMF in terms of the conditionalities. I'm assuming that you guys still have appetite to push back. If you don't, then maybe They just tax more, tax the base. But yeah, that's why I would prioritize growth.
Thank you very much. Chiriongo, you want to take a bite?
Maybe just to add on to what has been said, of course, it's everyone's interest that the policy rate should be aligned to market rates, but then there's a component of the risk margin. And I think there was a question by Langat that why aren't we having as low interest rates as other markets? And definitely there's a margin added to it in terms of risk, either from global market practitioners, the global lenders. They have to, if you are frontier, there is a component of risk that is added to you. So the question then becomes, how do we quickly finance growth, of course, with the implications around raising enough revenue. There is a lot of discussion around when the finance bill was shut down. It now meant that we only had one way. We had no opportunity for us to raise more revenue. So rationalize expenditure. That's why I think the discussions now are moving away from revenue-raising measures to rationalization of expenditures. So there's a shift, and I think the last comment in the IMF discussion was governance reforms. So there's a lot of discussion around, for us to be able to be more efficient with the little that we have, how best do we cut our cloth to fit the revenues that we raise now without necessarily having social outcomes that are not very, very good. That are not compromised at the end of the day, because it's the same people protesting against revenue raising that is protesting about the cost of living, that's protesting about bad roads, that's protesting about infrastructure of every kind. So we are at crossroads in many ways, but I think we only have one way out. How do we cut or seal leakages that are always there, so that all funds become investment funds to generate more for the economy? But I worry more about our potential to really be able to channel credit to more productive sectors of the economy. And I think, are we becoming more of a consumption economy or becoming more productive economy? Are we building the growth potential for the economy going forward, or we are relying more on imports, for instance? And of course, the more we lean on imports, the more we are exposed to the shocks that Gashao mentioned about anything happening in global markets feeds in very strongly, and therefore that again pushes up our vulnerabilities as an economy. So do we have a chance to build on buffers that enable us to be able to be strong to face headwinds with the strength that we so desire? So without a proper plan on how to invest on buffers, again, then we are in trouble. Right now we're recording about forex reserves at 8 billion more, but is it something that can be wiped out in the next shock without a replacement to it? I think for a long time we relied more on Eurobond funds to build on reserves, and there are other fundamental factors that can actually support the economy to grow our exports, to grow our remittances, to grow our FX earning opportunities, so that we have a better source of building our reserves than debt. That's the comment I would add.
So for the traders, what did you say the shilling is going? I'm just keeping them honest. So he skived the FDI question. He doesn't want to give the city view. He doesn't want to tell me where the shilling is going.
This is a problem with the brain trust. You expect an exact answer, whereas you can explain, then leave the teacher to get the solution.
So you want to go?
I think for the first time since I left school, last year we were doing math around where the shilling will go. The math was very pointed at the 188 levels. I learned not to try and do the math. We just trade where the currency is going. Sorry, and again, my trader is sitting there, standing there.
Yeah, maybe just not to. I am sure the traders know it doesn't matter where the currency is, whether as long as it goes up or down, it doesn't matter the level, right?
Yeah. Let's shift gears a bit. The next question is for Stephen Lagat, and I think it's a bit unfair that I'm asking you this question because the people that I probably the question the people that I should be directing this question to are not here, so it's a bit unfair, but at least give it a shot. So for the last 2 years, there's been a lot of reforms that have been instituted by the central bank, monetary policy, in terms of monetary policy. What is your take? Have they been impactful, and do you think more needs to be done?
Thank you for that. I think, I would say what central bank is, for lack of a better word, feeding us Piriton. Well, when the real problem we have is malaria. As in, we have a big problem rising from the fiscal side as opposed to monetary policy side. We have a government that has grown over 10 years with a huge fiscal deficit, around 7.5 consistently for over 10 years. This government at the same time has grown the economy through expenditure as opposed to revenue raising. And for the last 10 years, what they did was basically put up infrastructure projects that are not revenue generating and mark them to an economic growth. Look, did SGR and say economy has grown. And based on the growth of the economy, the economic value, they are now marking their borrowing to hit. And they're saying that the deficit is as a percentage of the GDP, a GDP that is infrastructure-led and non-revenue generating led. What that means is that you will continue growing and ballooning the debt that has been seen in the last 10 years. I remember the Kibaki left it around 1.8 billion. As we speak, if not for the currency coming down from 160, we would be at above 12 billion. As of now, we are around 10.6. And that in itself is at a level where a lot of debates are happening about whether we are sustainably managing debt or not. And that is the real reason that we are even experiencing downgrades, where we just by a whisker managed to pay the Eurobond by just rolling over. We did not actually pay it, but we kicked the can down the road. I don't know whether it will stop at where we have kicked it to, and we find there it has ballooned to a mountain. And in itself, I think the big problem we have in Kenya is not really revenue generation. It is the expenditure problem. We keep spending and spending irresponsibly, a lot of it wasted, a lot of it ending in corruption. And I can mirror this to somebody continuously eating junk food, eating well, and then finally they find themselves obese, and to sort the problem, instead of going to gym, decides to start buying food supplements and some items to manage the weight. This is what we are doing in government. We are just simply trying to say, okay, we can't cut on expenditure, but what we can do is to tax them more. You tax them more, touch their pay. I heard the cabinet secretary the other day saying those high revenue earning people can be taxed more. I thought he came from the other side where he was against it, but it seems like when you get to government, you start failing to think well. But in itself, the real reason that we are here and the problem that we are facing, that monetary policy is not going well, is because the biggest animal in the room is government. Government is broke, running around the world with a ball, begging ball. And here the central bank is thinking we can manage that problem of running around the world with a begging ball by cutting rates. Even if you cut rates and you don't have money, where will the money come from? And that in itself has even raised the problem of interest rates remaining up, even when we see that inflation is at 3.6%. T-bills, as we auctioned today, is printing 16%. And here, central bank is telling us the direction should be going down by cutting their rates down. And reason not coming back is because we know the government is broke, and even if we dangle 16%, they will pay because anyway they are broke, they don't have money. And complexities around this is happening, around the disruptions across the global economy that we have just been told by the gentleman from Moody's, where we have a lot of disruptions globally. And when you are having trouble with your neighbor has no food and you have no food, even if you go together and say you put together and make food, you can't have food when your neighbor doesn't have. So if we have a situation where everyone is struggling liquidity-wise, we cannot be able to say we are an island and we are able to get liquidity out of nowhere. And that is where the government is doing. For the first time, they tried looking for even sukuk bonds, Islamic bonds. They don't seem to be working. I'm yet to hear this United Arab Emirates borrowing. I don't know. They print for us 8.5. I always say when you see somebody shouting about a rate and all that, they are in trouble. They are just trying to pacify the market and tell them, you see, I have something here. Can you lower the rate? At least I borrow at a cheaper rate. So without ensuring that the government is disciplined and try to reduce the spending by basically cutting their fiscal deficit that we have seen. Currently, they are projecting 4.3, but you all know they are not disciplined. They will come up with a supplementary budget that will grow that to $1 billion anyway. So every time I see a supplementary budget in Parliament, I know that figure is growing. If they would have stuck to say currently we are borrowing the deficit as we stand, I think it's already in supplementary too. We have an initial budget that was thrown out. They went back with supplementary one under Kenya Kwanza. Then now I hear there is a new supplementary that has come under the so-called Grand Coalition. Is it Grand what government? Broad-based government. Broad-based government has come up with a supplementary with 768 or so billion deficit. I can tell you the moment we reach December, they will come up with another supplementary for pointing 850 billion deficit. Reason being, there is not much collection of tax. They will put it on Gachagua impeachment. They will push it on. They'll put it on Gen Z. They are not able to collect. And the reason being, they are not going to the issue that they are kept on spending elevated without knowing or seeing that the revenue is not coming as fast as they see. There is one big element that keeps on, even the economists like my parents, like Samuel and Raphael here. There is one fundamental change that happened in 2023 budget, I think, where they reduced the revenue collection through tax to T+5. So they are collecting much faster, and then the expenditure still depends on supplementary budget that MPs don't even focus on. They are now focusing on Gachagua instead of implementing a supplementary budget. Counties have no money. So the government keeps sweeping the money and spending very slowly. What that happens is that the economic activity goes down, as we have seen. And what does that mean? No much taxes being collected. That feeds through to now more and more doing what? Borrowing. So even if the rates come down at central bank, without that fiscal deficit, we are not going to see rates coming down as much. We will maybe come down to something like 15, nothing much down. And if the government was to wake up today and say, we have changed our ways, we have been baptized, and now we can wake up and say, let us spend responsibly without wasteful spending, then we would see things working. Thank you.
Thank you very much. And I think the questions have been well answered. I'm sure you guys have very good questions that you want to ask the panelists. And just want to open it to the floor. Anyone with a burning question before we wrap up?
Thanks, Andrew. I think anyone can answer this. Across the markets, across the FX markets, I believe what the biggest challenge we're currently facing is shrink in margins. Do you think that is going to change?
Let me try to answer this. The margins have not shrunk. This is where the market was. What you saw was abnormal, and it was meant to be for a very short time. So this is how, actually, the markets are still wide, because I think before COVID, we traded 5 cents, or used to trade choice price. And we used to hear best bid, best offer everywhere, because markets were very thin. So this is how the market was normally. I know it looks a bit strange now, but for the longest time, it's been like this, that the period where your margins were elevated was the anomaly. So I think it's just how you adapt to or readapt to how markets should be or how markets were.
Thank you very much. That was a question from a Gen Z, so you understand why. Thank you, everyone, for the question. Anne?
I guess, okay, my question can be answered by anyone. It's on the debt space. I know a lot of it, Steve has spoken to a lot of discipline that we need to have in terms of the government spending. But as market practitioners, my question is, how can we drive the conversation, particularly on the foreign debt, to sort of try and help manage that in terms of maybe proposing risk management products or solutions that the government could use so that the debt doesn't, because I think a lot of the times is as long as you're borrowing money, even if it's someone who's giving you money at 10%, you're willing to take it, but then the market dynamics change. So how can we drive that conversation? I know there's a lot of political influence on that aspect, but maybe a possibility of how we can drive that conversation.
Yeah, I think the biggest way on that is going more on bilateral borrowing, where we are taking concessionally for a very long time. The government has been going for World Bank and IMF, which are usually a bit of concessional. So the only challenge with that is with these Bretton Woods, you find a lot of conditions coming. They polish you a bit. So you pay expensively through market, or I would say commercial loans like Eurobond and all that, but you don't get a lot of policing, and the government will like that. They like where they are not being asked questions. But at this point in time, when we are, I would say we are at a level where we have no choice but to try and manage the debt, they should go more of government to government or bilateral through the Bretton Woods, where we are trying to
Let me just pick up something, Annie, you have asked. And we're just trying to do some quick math here. The banking industry, we're looking at it as an asset size of about 6 trillion. I believe Dr. Tirongo mentioned we have 25% of that in foreign currency. So just about 1.5 trillion, if my math is correct. Now, look at then the composition of the FCY holdings that commercial banks have. So you collectively house about what, 10 to 11 billion dollars in terms of FX that you're holding. That's even higher than the CBK reserves have ever been. We can strip out for some of the hubbing that we do, some of us who have hubs and we have liquidity, but that's part of the promise that Kenya has, that we become the financial center where we are pulling liquidity from the region. My take, and this, I don't have the same conviction like my brother Lagat here, but we do need to engage, particularly the regulator, the National Treasury, around risk management policies, products, solutions. We have seen other national treasuries. I think Uganda has been very open to these engagements. The Rwanda Central Bank has also participated in risk management products to support the economy. And the Kenya one, we have, unless maybe there's something going on, for the longest time, the Kenya market has been only at the commercial bank level. Central Bank is not participating in risk management products, neither is the National Treasury participating. So we look outward as opposed to then sorting out our issues. One of the treasurers has been actually very vocal around, we are not scratching around the capabilities that this room has, that the financial markets in Kenya has. We are not, we have been very, and Avon, you asked a question, because we are very happy to just trade in that 10-cent range. That can be done by anyone. The question is, at what point do we then actually deepen the financial space in this marketplace, such that the tools and trades that we learn, they stop being theoretical. We actually start bringing them onshore and actually start trading them here. I believe we have a responsibility in terms of putting the financial landscape in a different level. We have a responsibility in pushing for these agendas. And within us, we have different skill sets. We have different exposures. We are all, different institutions. The question will be then, collectively, what can we do? Our balance sheets can support some of these things. There is a fear that we cannot issue dollar-denominated bonds locally. Is that fear grounded? Probably. there are many elements that we are afraid as a country, as a financial market to go into. We do need to get some bit of, move to that level of participation to actually start sorting out our problems ourselves, as opposed to ceding to the bigger banks and the guys who now hold us hostage at these rates.
Thank you. I just, when you was talking, I just remembered what I've been pushing with central bank. So I've actually been telling central bank, other markets, when they are managing their CRR, consider all the clearing accounts. We have, as you mentioned, a lot of foreign currency that are seated at 0% at central bank. We have a lot of cash that is in false and at the same time in the clearing accounts. But for some reason, when you are managing our CRR, central bank looks at the shilling only. Can you imagine how much they can release to the market if they were to add together all the foreign currencies that are seated in central bank together with cash and together with the clearing on shilling, and factor that in the clearing in the CRR. I work for a bank from Mauritius, and Mauritius do that. They consider every item that you have in central bank, including your bonds, as part of your CRR. And it releases a lot of liquidity that can now be used to invest in these bonds and also on lend to customers. It releases, like you mentioned, it's more than how many? A trillion, around $1 trillion. If you bring that into CRR, you will release quite a bit in terms of the pressure that they are looking in borrowing. Thank you.
Good evening, all. I think for me, I'd have wanted to hear more about the G2G, being the end of a cycle and being the end of a contract that has, as agreed, we know. Government used it to try and sort out a problem that we had as a country in terms of the shortage of the dollar. We've said it very clearly that they're actually kicking the can down the road. And for me, I believe now we are down the road. So for how long? And are we ever going to get a soft landing to it? Because once we have to pay for, we're actually running, is it 3 months behind? So if the contract ends in December and the OTC also opens up in maybe January, what happens to this market? Because for me, I believe that's the only other event that can spur the market. Currently, we are seeing a very dead market, but nobody talked about that contract that can easily spike the market to where we were, I think, when that process began. So if we can get a better understanding, I guess it's a time where now we can also now see a reemergence of the derivatives market, which was also very dead. Because is it time for us to now start locking in the dollar cost for our clients or for us to at least help manage the risk that is expected? So if we can get more, if anyone can shed more light on it, then I guess it assists us in making decisions that we expect by the end of December.
Maybe as Rafael, I know Rafael knows it better. Maybe as he mentions about the G2G has always been said, helped to reduce prices, helped to whatever. But the real reason for G2G is just to maintain supply of oil. At the time there was scarcity of dollar, I visited a few oil marketers, and they normally, oil marketers leave oil for at least 20 working days, 20 days. At some point during the time there was very little dollars in the market, they were keeping 1 or 2 days. And we saw a lot of fuel shortages around. Those fuel shortages were just mainly caused by the shortage of dollar. What happened at the time was that everyone who needed oil, especially the small oil marketers, had to purchase it in dollars. And what that meant is that unless they get dollars, they can't get any more oil from the bigger oil marketers or from the oil reserves that are kept at the KBC. So what that meant was there was a lot of oil shortages we were seeing. And when G2G came, now what happened was that risk of looking for dollars were concentrated on a few, I think 3 importers. And what that meant was they had to be given room to accumulate dollars through now the LC route. So that 3-month to 6-month room was enabling them to accumulate dollars as they receive shilling from the smaller oil marketers. That means that you can't go on like this for so long. We have to revert back, especially the government and the central bank, instead of buying $800 million in the last few weeks, they should have allowed the market to accumulate dollars, because I don't see them rolling come December. When it comes December and central bank is the only one with dollars, they must have to support the market, otherwise we are back to square one. Thank you.
Yeah, I think so you sort of nailed it. I am not an expert on G2G, so just for the record. And it was addressing the commanding heights question, which is you need a strategic resource to flow through. That's collapsed on the back of an FX liquidity problem. So if you talk to the administration, I think they actually count it as, they think it was a significant success. That's their version. You can take whatever you want from it, but it was addressing that supply question, and to keep the oil taps flowing, so you get government-to-government arrangement and get things go. The question you ask is around when is it, since it was like plaster for a wound, is the wound healed and do you take off the plaster? And so the December question. I think the cyclicality of, and just keep in mind that petroleum products is still our single most sort of biggest import, okay? So it's a sensitive resource. I see political appetite for some continuity. The economics, and/or policy, rights and wrong notwithstanding, especially because we are 4 weeks out. So I see some sort of potential extension. Now, I don't think that whether it's good policy or not, I don't know. Keep in mind that the doomsday scenario that we all played out, including the IMF at the time on the program, has not been borne out by the actual outcome. So they've got some little credibility on this in terms of whether or not the policy was right. You can leave it out. But if assuming they take it out, or rather we go back to the OTS, and interestingly, Gashara has given us a very prescient view of what that normal world looks like. It goes on as normal with the margins that the Gen Z was worried about. Again, to my language to you, in a monthly cadence of so demand supply reverts back to that monthly whatever that we are used to, and life goes on, right? That's the normal world that this you tried to entice us to. So I don't see any challenge. I think the currency liquidity, well, the dollar liquidity problem was when we can talk endlessly about the market microstructure mistakes that were made, which brings me to something I think we need to put on the record, and Andrew, you asked it, to Steve. And Steve went on this good sort of critique of the country's fiscal path. But your question was central bank reforms, right? And what sort of verdict? I think and Chair can speak to this. I think in terms of the posture to drive meaningful market conversation and market reforms, I'd rate them at A+. The new administration of the central bank. I think we can all say, those of us who go there regularly, you guys can back me up on this, very consultative, very willing, even when we disagree, very willing to try whatever we pass across to them as market practitioners. I think in terms of policy design, again, I'd give a very strong rating. We spoke about the monetary implementation frame. As a matter of fact, all the criticism here, including Steve's eloquent one, started by acknowledging that the monetary policy side is great, right? And then pivoted or segued into this huge, correct critique on the fiscal side. So I'll answer you very, very candidly. I think they have tried, given the circumstance and even the past mistakes, the context in which they were making policy. I think the story is yet to be told on what exactly they forced. For some of us who study these things, it's going to be a while before we get. So I think that there's a right attitude, there's a right posture, and there's a right spirit to drive even better reforms. That's my view. Thanks.
Thank you. Do you have any more burning questions? At least one. I can see very tired faces. Maybe it's a cue for us to...
The last question for you, Chair. Through this entire session, we've been hearing music from the other side. Is your party going to be as good, or do we have to relocate to the other side?
Let's first finish, and then let's cross that bridge when you get there. But there's something for us after this. There's going to be a dinner, so don't be in a hurry. So if you feel like maybe you've been sipping on water, there's food outside. So relax, and everything is sorted. So do you have any more questions before we bring it to a close? I think I'll take that as it. And allow me to appreciate our panelists. I think they've done a great job. Thank you very much. I really feel like the questions have been answered well, and they've been articulated at length. So, and I hope that you've been taking notes. This forum is for us to interact and share our views. And it's my hope that you've taken a few notes, and some of the questions that probably have been lingering in your minds have been addressed. Thank you. Let me invite the chair for the Treasurers Forum, not Doctor.
Yeah, next time you...
Maybe Philip.
Next time you balance the panel, Chairman.
Yeah.
Mutahe and the old ones and Eva, the old ones, they need to hear. It's too testosterone.
Point well taken.
Thank you.
Yeah, please. Yeah.
Thank you, Chair. So mine is to thank you. You can see I'm in a hurry because we need to have a good bite. For those who don't know me, my name is Philip Wambua. I'm the Chair of Treasurers. And I work for ABC Bank, and I've worked for several banks together with some of you who are here. Thanks, Chair, because I had the opportunity to make some opening comments. And again, I have the opportunity to thank the members. So first, thanks is to the ACI leadership. And since I come from a little bit of the old school, can we see the leadership of ACI by standing? Just to appreciate. I know Malaika is there, Andrew is there. Oh yes, this great team here. Philippa, okay, thank you very much. Okay, secondly is to KBA and our partner. KBA is our partner, Dr. Tiriongo, a friend of mine, and Kennedy is our member. Kennedy Mutisia is a member of Financial Markets Committee. Thanks to KBA. Thanks for your support. We are talking to KBA to help us to set up a secretariat so that sometimes we are not asked directly by central bank. They ask an office. That way we can now be more vocal. You can find them in Citizen Television, but for now you cannot dare sometimes. It can be difficult. So thanks, Dr. Tiriongo. Thanks for your support. Pass our greetings to Kennedy. Number 3 is, of course, the treasurers. I know there are many, but because the group is big, can you just not the ones who are seated here. Those are very special people. Other treasurers, I know Mutai is there. Who else is there? Mary. I had Mary somewhere. Oh, Mary is there. Mary of DIB. She's acting CEO. She's my daughter. I call her my daughter. Mary. Any other treasurer? Okay. Thanks, treasurers, for coming. Yes, another one is here. Thank you for coming. Anybody else? Okay, sawa sawa. Of course, the panelists, we have to do more of this, Andrew. More of this, and as he said, we'll add one more for a lady, or two more, so that they bring another very deep perspective. You know, whenever we go to Central Bank, I noticed, when I go with Motae and other ladies, sometimes the conversation is better. Because I put them on the front and they look at David, and you see David reacts differently. So thanks, we'll do that next time. And finally, to our members, ACI, thank you so much. Thanks for your enthusiasm. Thanks for coming. You know, at some point I thought we'll have just a small group, but it's a whole, the hall is full, so thank you so much. And finally, I want to thank the chefs in advance, because we need to have something to bite, and thanks for organizing the dinner. So thank you so much, and God bless you. I think somebody's going to pray for the food, I was told. So, Mutai. So asanteni sana. Thanks, and God bless you.
You know, it feels like your family has hosted visitors, the men have spoken, and then now the wife is told, come and pray for the food. But anyway, I shall still pray for the food. But it's good to see you all. At least tomorrow we have a holiday, so I hope the budget, yes, will allow. But thank you for this. I'd say maybe not in the economic space, but in more so of our talents, our career growth plans. And sometimes you don't have to wait for someone. Sometimes you need to do it. So why is it that, let me, like now, for example, Central Bank doesn't trade swaps. Like, I don't know, maybe in 2050s, when some of you will have other generations, on a light note, I hope I'm not quoted, but I think it's in terms of we have banks that trade certain things. What makes it difficult for us to learn it, to come up with our own measures, to start publishing those prices, whether on Refinitiv or Bloomberg? Why is it difficult? Why can't we do it? So for me, that's my challenge. And over the years, talent is what is decreasing. So you need to create a space for yourself and a name for yourself. Those would be my few remarks. Yeah. So challenge us here. Let the conversations change. Ask me, why aren't we doing an option? What's the problem? Is it market risk? What is it? And there are things that we can do. Gashao, I know math. We'll look for other mathematicians. But anyway, let's stand and pray for the food. Father, we thank you for this evening. We thank you for ACI and the leadership. We thank you for each and every person that came. Father, I pray that you bless the food that we are about to eat. We also bless our nation and even our regulator. And I also pray, O Lord, that you help us in our own capacities to just take this country forward. that we really don't need, to an extent, the government, that we can actually create the change that we want to see. I pray, O Lord, that even as we go home, you watch over us. I pray even for our payslips and all the drama around our payslips, that you be our provider, that you provide all that we need. I pray even for each and every person here, their families, that even for them, that, Lord, you meet them at the point of their need. So we thank you for life, and we also thank you for all that you've done for us. Pray for institutions, for KBA, and everybody else. In Jesus' name we pray.